So good morning. Today I'm going to discuss about an international financial management, and today's class will be on an introduction to international financial management. Before getting down to the subject international financial management, we need to know about what is financial management is all about, or we need to have a recap. If you've already studied about financial management in your lower semesters or in your degree level classes, it's better to recapture about what you studied in the financial management. So financial management basically involves taking of three important decisions. One is financing decisions. Number two is investment decisions. Number three is dividend decisions. So financing decision is nothing but the decisions involving in raising of funds from various sources. The fund is raised through equity funding, debt funding, issue of bonds, debentures, or some portion of funds which is generated out of the operations is plowed back, which is known as retained earnings, or the organizations might go for loan fund from long-term loans from financial institutions or developmental banks. So that is the first source of funds. So these related issues are that, when you're raising funds, you need to know about the markets from which you can raise the funds. Capital market as well as money market. Capital markets are the markets which are serving long-term, which issues long-term sources of funds through which you can raise long-term sources of funds like debt as well as equity. You need to know about capital market operations there. So the capital market involves the market in which there are three important segments like equity segment, wholesale debt market segment, as well as financial derivative segment. So as a financial manager, you need to know all these kinds of markets and its working and its operations and what procedures and formalities to be undertaken to raise funds and register your company to a stock market. These are the issues which is raising of funds. Now, the second important decisions in financial management is application of funds. The funds which you raised through equity or through debt or through bonds or retaining some portion of earnings, that involves certain costs as well. As far as possible, you need to reduce the cost, and overall cost of capital or weighted average cost of capital should be minimum. Of course, the funds which you raised is not raised for the sake of raising funds. It has to be utilized for long-term projects, the projects which generates series of cash flows in future time period. So the investment in long-term assets is called as capital budgeting decisions, or simply it is called in corporate parlance as capex. Capital expenditure or capital budgeting decisions involves commitment of firm's current fund in long-term assets in anticipation of an expected flow of cash through series of future time period. So it's a kind of cash flows. Initially there will be cash outflows in the year zeros, or sometimes additional also it is required for meeting working capital in the later years, and then series of cash inflows. So capital budgeting decisions evaluation is an important technique, an aspect of financial management in local financial management. It is also applicable to international financial management. You have different techniques of evaluating capital budgeted decisions. You have non-discounted cash flow technique as well as discounted cash flow techniques like DCF techniques. So important techniques are discounted cash flow techniques, which takes into consideration time value of money like NPV, net present value, profitability index, PI, as well as internal rate of returns. These consideration has to be taken while investing in long-term assets. Not only that, you also require fund for managing day-to-day working of your business. The funds required to manage day-to-day working of your business is what we call as working capital. So the need of working capital arises due to the fact that you require working capital to meet the day-to-day expenses. So there is something known as operating cycle. So operating cycle is the journey between cash to cash through various sequence of operations like cash. From there you take inventories or stock and debt, and then again what we call back to cash. So this journey between cash, you start with the cash and ending with the cash. So you're realizing the cash. So you start with the cash and realizing the cash, you require a lot of time period. Sometimes the time period will be longer, sometimes time period will be smaller. For manufacturing organization, the working capital will be more because you have a longer operating cycle. Whereas in a trading organization or service organization, it is very short. You take the case of small hotel. What happens is that a person who goes to hotel in the morning and with the cash, and he goes to market to buy the commodities required to prepare dishes, and he sells it in the noon and he gets back the cash. So here operating cycle time period is very slow, very fast, in the sense you quickly realize your cash and you get your cash back immediately. Whereas in a manufacturing organization, like if you go to Camco, which processes chocolates and all that, which gets a raw material like cocoa, which requires longer time period to process, and maybe 2 months or 3 months to complete a batch of production, because of a lot of processes involved in that production process. So their working capital requirement is longer. So anyway, so working capital requirement is an important requirement in financial management. So management of cash, management of debtors, management of inventory, and management of receivable is an important aspects of financial management, which we have to study in the local parallels. Then the third important aspect is that which we discuss in the financial management is dividend decisions or management of surplus. The funds which arise out of operations of the business, that is, we call it as a profit. The profit from the operations can be, sometimes you get 30%, 40% increase in the profit over a period of time. Companies like Infosys is generating a growth in revenues over a period of time. So when you're getting increased return or increased profits over a period of time, that profit sometimes may be utilized for, you need to utilize it for paying dividend, but sometimes payment of dividend is not sufficient. You may require to utilize your funds for certain projects which fetch you lots of income. So such circumstances, you have to decide whether to plow back, whether to retain your earnings or to distribute the earning to the what we call shareholders. So you require earnings to be distributed to shareholders, because shareholders, one of the criteria to investment in companies is to get a regular pattern or regular dividend. Another important aspect is that if the company is able to generate more return than the individual himself by paying dividend, then it is better to retain companies, because if you are retaining the profit in companies will utilize that profit for various profitable projects, so that the amount will be reflected in your appreciation, capital appreciation, or increased market value of shares. So that is the third important aspect which I discussed in financial management. So 3 important aspects of financial management is raising of funds or financing decisions, application of funds or investment decisions. Under that we have 2 aspects. One is capital budgeting, another one is working capital. The third one is management of surplus or dividend decisions. These 3 decisions are very important from the local parlance of financial management. When it comes to international financial management, you have a different environment there in these areas. One is that when you are going for international financial markets, when raising funds, you have a different route of raising funds. The different route of raising fund is that the international stock market is different from the stock market or capital market which is prevailing in our country. So when you go to America, you may have to get route your finance through ADR. If you want to raise your funds, you have to raise through American Depository Receipt, or you have to utilize GDR, Global Depository Receipt. Also, you have to work under you have to know of the working of one of the some of the important world markets, like the Japanese Tokyo Nikkei, and you have to know about Wall Street or New York Stock Exchange and other stock exchanges, also the stock exchange indices, which is reflecting your performance of your stock. Sometimes it is a true reflection of your performance in stock. So these aspects also you need to know when you enter into international market. So that's the first issues which is different. The second thing is that whenever you go to international markets, the international capital market operates in a different way.